So what is Target's emergency move? And is it a sign that we should be doing something differently to protect ourselves? To answer this, I need to go back a couple months. And that is when Target noticed that they were losing market share, that their sales were down, and they had to do something drastic. So they cut prices on 5,000 different items. Let's start off and look at this update first by Target itself, their press release. This is back 3-4 months ago, and they said Target will help consumers save big by lowering prices on 5,000 frequently shopped items. And that story was picked up by NPR, and they said Target's cutting prices on 5,000 items, including milk, butter, and pet food. Now, did all of this work? Did it work? Did lowering prices, did it bring back the consumer? As you would guess, if you're a retailer and trying to get people to shop, one way to get people to come back is to lower your prices, and to keep shopping with you is to lower prices. But it's not your preferred method, right? You'd rather they come back for other reasons, because that's a deadly game once you start lowering prices. Okay, Forbes picked up on that press release as well. And not only was it Target, but it was Walgreens, Amazon, and Walmart, in addition to Target, that announced what Forbes called summer price cuts. And then Yahoo Finance just recently picked up an article, and they said, a story, and said, okay, how did it work for Target? So Target recently released their earnings. They're a publicly held company, so they shared with the public, hey, here's how the last quarter has gone. And Yahoo Finance says Target cut prices on 5,000 products. Now it's back with a big earnings beat. But don't just read the headline. We need to dive in. So let's see what they said. The discount retailer shredded Wall Street forecasts on the Wednesday of this report, topping them by 39 cents per share on the back of renewed traffic to stores. The traffic increased 3%. And all 6 of Target's major departments saw a lift by rising prices. So they lowered prices, but remember, traffic, while the 3% growth in traffic is good, and it's much better than what Target was saying, which was negative quarter-over-quarter sales growth and traffic growth. So it's good news, but it's not like they knocked the doors off of the park, they knocked the ball out of the park and people started returning. This here says that Target stock, so why they didn't necessarily, get a 10% increase or a huge number, look what happened to its stock price. Its stock price jumped 12%. We're going to see an update that's even better than that after that. So Wall Street was really happy with this report, but we have to keep looking in. Let's see what their forecast looks like going forward. The Target CEO's Brian Cornell, according to the article, tells it the retailer comeback quarter reflects a steady dose of price cuts this summer on 5,000 daily essentials, items which Target was losing market share to rival Walmart for several quarters in a row. And Cornell goes on to say, we feel great about the reaction that we're seeing from the consumer based on the 5,000 items where we've seen price reductions. It certainly contributed to traffic growth during the quarter, and we expect that to continue for the rest of the year. However, Cornell did say, he declined to say whether there's going to be more price cuts, which is probably a good thing, right? If it's we're really going to start targeting lower prices, well, of course that's going to bring in more people. We want to see the consumer start spending again without having to trade down and without having to do drastic price cuts. But the flip side of that is the price increases were pretty dramatic since the pandemic. And so the Yahoo article closes with, Target stayed cautious with its full year guidance as it entered the peak season of back to school and holiday shopping. But it did lift its profit forecast for the second quarter and improved traffic trends. Okay. So the profit forecast, but as we're going to see in this next article, not necessarily its revenue forecast. So let's look at this article by Reuters, and it says Target raises 2024 profit forecast as price cuts draw shoppers. So the summary here is their comparable sales were up 2%. They raised their profit forecast to $9 to $9.70 a share, which is a fairly significant increase, particularly on the lower end, from $8.60 a share to $9 on the low end, and then on the high end from $9.60 to $9.70. And here you can see Yahoo had it reported that at the time of their reporting, Target shares were up 12%. Here we can see they're actually up 16%. And the article goes on to say Target's results reflect a similar strategy by Walmart and other retailers looking to attract increasingly price-sensitive consumers. And the article says it shows that the U.S. consumers are constrained but not in recession mode. That's important to know. They're holding out for deals but have some financial flexibility, is what analysts and industry watchers are saying. Okay, then let's keep going. So there was where Target had negative sales growth for a while, so this reversed more than a year of sales declines. And Target had reduced prices on those 5,000 items, including bread, soda, paper towels, and pet food. And in February, it introduced a new private label basics line called Deal Worthy. We saw this earlier. Walmart did something similar, and it had a lot of traction. Their new brand that's for price-sensitive consumers. And they have almost 400 items, again, priced for price-sensitive consumers, all priced under $10. Additionally, it expanded its goods and gathers and favorite day brands by adding 125 new food categories. Again, a strategy we've seen employed other places as fast food restaurants like McDonald's continue to have high prices, and the consumer is cutting back from McDonald's. They're actually starting to buy ready-to-eat, pre-prepared, partially prepared meals at both Walmart and Target. So they're actually trading down. They traded down from higher-end restaurants to fast casual to McDonald's types, and now the consumer is slowing down and trading down to eating at home, which is not all bad, right? It's probably much healthier to eat at home and certainly less expensive. Okay, and here's what one analyst or one investment manager had to say about this, that owns, this person's firm owns over $150 million of Target stock. And he says when your budget's getting squeezed, that works in Target's favor, but it probably hurts Macy's and Nordstrom's. But it helps Target because they're providing a low-cost alternative. This is according to Bill Smead, who's the Chief Investment Officer at Smead Capital Management. So consumers continue to trade down. We're seeing that trend here. And then importantly, Target retained its full-year comparable sales forecast of flat to up 2%. So they raised their profit forecast, but they kept everything else at flat to 2% for revenue. So why are they doing that? They're doing that because they continue to see the consumer being cautious. The U.S. economy is at a really precarious place right now. As I record this, the market is hoping to see the Federal Open Market Committee, for the first time in a couple years, lower interest rates. And they're doing that because they feel that inflation is under control. But remember, the Federal Open Markets Committee has a dual mandate. One is to keep inflation under control, but the other is to keep us at full employment. And I think they're lowering the rates because the risk of people starting to lose their jobs and beginning this downward spiral is continuing to unfortunately increase. Our goal, everybody's goal, is that the Federal Reserve can bring us in for a soft landing. And unfortunately, time is not in the Federal Reserve's favor, and unfortunately, time's not in our favor either when we think about our own health, our own retirement. And that's why I made this video up here that talks about why retiring at 65 might be a big mistake. Thanks for watching this one. I'll see you in there.